Welcome to the Wall Street Wish List, an investment shopping list from seasoned analysts. And each of the analysts featured today are from Noble Capital Markets, an SEC-registered, FINRA-licensed broker-dealer. Before I introduce the analysts, I want to remind you that this program is provided for informational purposes only, and none of the content should be interpreted as a recommendation or solicitation to buy or sell securities. Investment decisions must be made by you or with the support of your financial advisor. A complete disclosure statement follows each analyst presentation. Let's get going. Joe Gomes is a senior generalist equity analyst. Joe has over 30 years of experience as a generalist analyst, covering both small and mid-cap companies. He is a chartered financial analyst and holds an MBA in finance from Pace University. Welcome, Joe Gomes.
Hi, my name is Joe Gomes. I'm the senior generalist analyst for Noble. I'm going to give you a brief update and overview of some of our outperform companies here for 2023. It's going to be a little bit long, but we'll make our way through it. So the first, we're going to start with those that we classify as in the strong cash flow bucket. The first company we're going to talk about is ACCO Brands. The symbol's ACCO, trading at $575 with a $542 million market cap. It's outperform rated with a $12 price target. ACCO is one of the world's largest suppliers of select categories of branded academic, consumer, and business products with revenues of nearly $2 billion. The company markets products in over 100 countries across the globe. Brand names investors would recognize include 5-Star, At a Glance, Swingline, and Powerade. The company's top 12 brands represent approximately 75% of revenue. Through organic growth and acquisitions, ACCO has transformed itself into a consumer products-oriented company with an increased presence in growing channels such as e-tail and mass merchants. ACCO generates very strong cash flows, which have been used to deleverage the balance sheet, fund acquisitions, and return capital to shareholders. The company currently sports a 5.4% dividend yield, with the shares trading at 5.3 times projected 2023 earnings, less than 0.3 times sales, and 9.7 times EBITDA. We believe there's significant upside potential to the shares as the worldwide economy improves. The second name we want to talk about is Commercial Vehicle Group. The symbol is CVGI, currently trades at $7 and a penny. It's got a $244 million market cap, outperform rated with a $10 price target. Commercial Vehicle Group is a problem solver. Through its 4 operating segments, the company manufactures parts for heavy and medium duty trucks, is expanding into the electric vehicle market, and manufactures warehouse automation equipment. CVG is undergoing a transformation, taking a market leading supplier and leveraging its application engineering and low CapEx business model into brand new markets to create a more profitable and less cyclical company in our view. CVG has targeted exciting high growth potential markets, including electric vehicles, which is projected to grow at a 54% CAGR through 2030, and warehouse automation, which is projected to grow at a 15% CAGR through 2027. The company has won over $2 billion of new business in the last 2 years and has a global pipeline of opportunity exceeding $5 billion. At the current price, CVGI shares trade at 8.8 times forward earnings estimates, 0.25 times sales, and 8.9 times EBITDA. Strong cash flow generation is deleveraging the balance sheet and self-funding new growth. Recent higher value added contract wins, along with price increases on legacy contracts, will help improve operating results going forward in our view. The next company I want to highlight here is CoreCivic. The symbol is CXW, currently trading at $12.09. That's with a $1.4 billion market cap, outperform rated with a $15 price target. CoreCivic is a diversified government solutions company with a scale and experience needed to solve tough government challenges in flexible, cost-effective ways. CoreCivic provides a broad range of solutions to its government partners that serve the public good through high-quality corrections and detention management. The company is the nation's largest owner of partnership correctional, detention, and residential reentry facilities and we believe it is the largest private owner of real estate used by government agencies in the United States. Now, it is a controversial name given its business. However, CoreCivic produces outstanding recurring cash flows. In addition, the long-term nature of its contracts and high renewal rates, combined with a lack of alternatives to its services, provides a sustainable business even in difficult economic environments. The company's real estate is worth significantly more than the current market cap, as evidenced by the recent sale of its McRae facility, which, if we took that per bed value, was applied to the rest of CoreCivic's property portfolio, would value CoreCivic at $30 per share. In addition to deleveraging the balance sheet, CoreCivic is using its strong cash flows to repurchase common shares. Through November 1st, the company repurchased 6.6 million shares, or about 5.5% of the outstanding shares, for $75 million. Over 150 million of repurchase authorization remains. At the current price, CXW shares trade at 12 times forward earnings, 0.8 times revenue, and 6.6 times EBITDA. Our next name is the GEO Group, symbols GEO, currently trading at $11.52 with a 1.4 billion market cap, outperform rated with a $15 price target. Similar to CoreCivic, GEO provides complementary turnkey solutions for numerous government partners worldwide across a spectrum of diversified correctional and community reentry services. From the development of state-of-the-art facilities and the provision of management services and evidence-based rehabilitation to the post-release reintegration and supervision of individuals in the community, GEO offers fully diversified, cost-effective services that deliver enhanced quality and improved outcomes. GEO benefits from the same industry trends as CoreCivic, but also has a fast-growing alternatives to detention segment that is benefiting from a move by government corrections agencies to home detention as opposed to incarceration. Operationally, the company is generating record quarterly revenue and adjusted EBITDA. GEO also trades at a significant discount to the value of its property portfolio. GEO recently underwent a significant restructuring of its debt, pushing out maturities until 2026. We expect the strong cash flows being generated by the company to be used to further reduce debt, with the potential of a share repurchase program once debt levels are reduced further. At the current price, GEO shares trade at 9.3 times forward earnings, 0.6 times revenue, and 6.8 times EBITDA. We're next going to move to Information Services Group. Symbol is III. Shares are currently trading at $5.08. Company sports a 243 million market cap. This outperform rated with an $11 stock price target. Information Services Group is a leading technology insights, market intelligence, and advisory services company. Company has clients in both the private and public sector. They enable businesses and organizations to optimize their operations through research, benchmarking, consulting, and managed services with a focus on information technology, business process transformation, program management services, and enterprise resource planning. With a focus on helping clients optimize operations and get the most bang for the buck in spending, ISG has carved out a niche in the crowded consulting field. Since adopting its ISG Next operating model, the company has experienced strong cash flows, which we expect to continue. Recurring revenues continue to grow and now represent roughly 35% of overall revenue. Management's goal is to grow revenue in the high single digits and earnings at 1.5 times revenue growth. At the current price, III shares trade at 11.9 times forward earnings, 1.0 times revenues, and 8.7 times EBITDA. This compares to a peer group which trades at 22 times earnings, 2.4 times revenue, and 13.8 times EBITDA. With its focus on digital transformation and the ISG Next operating model, we believe III shares have tremendous upside. Our next name we want to talk about is RCI Hospitality Holdings. The symbol is RICK. The shares trade at $83.05. It has an $830 million market cap. We currently have it outperform rated with a $100 price target. RCI is another controversial name. It is the only publicly traded operator of gentlemen's clubs in the United States. In addition, the company operates a chain of restaurants under the Bombshells moniker. The company is building a portfolio of well-managed, high cash flowing nightclubs and restaurants. RCI currently operates 52 gentlemen's clubs in 13 states and 11 company-owned Bombshells restaurants, with 1 franchise Bombshells in operation and agreements with franchisees to open additional locations. Free cash flow has grown at a 16% CAGR from 2015 to 2021. Management here is a follower of William Thorndike's The Outsiders book, which talks about other key high-performing investors. The company uses a disciplined set of specific guidelines for its free cash flow use. Right now, they do 3 things: look at acquiring additional clubs, opening new restaurants, and repurchasing common shares. There remain some 500 clubs that fit the company's model that could be potential acquisitions going forward. And we believe the Bombshells concept could easily support 100 locations. At the current price, RIC shares trade at 15.6 times forward earnings, 3.3 times sales, and 15.1 times EBITDA. With significant organic and inorganic growth opportunities and a disciplined use of free cash flow, we believe RCI is well positioned to grow in excess of the market. Finally, for this segment, we're going to talk about V2X. A symbol is VVX. The stock is selling at $38.89 with a $1.2 billion market cap. This is outperform rated stock with a $62 price target. V2X is the moniker adopted upon the merger of Vectrus and Vertex. The company is a leading provider of critical mission solutions and support to defense clients globally. The company delivers a comprehensive suite of integrated solutions across the operations and logistics, aerospace, training, and technology markets. V2X actually could fit into a number of buckets: strong cash flow, growth in a tough economy, and a catalyst. The late summer merger between the 2 companies created a powerhouse in the converged solutions marketplace. Access to expanding and higher margin markets at the intersection of technology and operations. Historically, V2X has punched above its weight, winning major awards such as LogCap 5 and OMDAC SWAPA against much larger competitors in the defense vertical. We believe the combination opens a significantly larger, addressable, faster growing market at higher margins for the combined entity. At the current price, VVX shares trade at 0.65 times pro forma revenue and 8.1 times pro forma EBITDA, compared to a peer group average of 1 times revenue and 15.6 times EBITDA. We believe the combination of the 2 firms opens a significantly larger, addressable, faster growing market at higher margins for the combined entity that will drive valuation multiples even higher over time. Next, let's move to the low leverage bucket. The first name we want to talk about here is Bassett Furniture. The symbol is BSET. Currently trades at $17.85 with a $169 million market cap. We have the shares outperform rated with a $32 price target. With a 120-year history, Bassett Furniture is a leading manufacturer and retailer of premium home furniture. Approximately 75% of Bassett's furniture is manufactured in the U.S. and sold through 95 Bassett branded stores and over 700 independent retailers. The premium home furniture market has a number of tailwinds driving growth, including rising household incomes, the move to a hybrid working environment, significant new housing pipeline, and increased demand for second homes. Always a conservatively managed company, following the sale earlier this year of its distribution business, Bassett had approximately $9 per share in cash and equivalents on the balance sheet at the end of the most recent quarter and no debt. The shares sport a 3.6% dividend yield, and management has historically declared special annual payments to go along with the annual dividend. At the current price, BSET shares trade at 11 times forward earnings, 0.3 times revenue, and 4.4 times EBITDA. While the operating environment remains challenging, expected increases in household formation, expansion into new niches, and a strong balance sheet place Bassett in a favorable position going forward, in our opinion. Next, we would turn our attention to Kelly Services. Symbol here is KELYA. Stock is trading at $15.86 with a $600 million market cap. Outperform rated with a $25 price target. Kelly Services is one of the largest staffing companies in the United States. The company provides workforce solutions to a diversified group of customers in 3 regions: the Americas, Europe, the Middle East and Africa, and Asia Pacific. The customer base spans a variety of industries and includes more than 75% of the Fortune 100 companies. Kelly is the largest provider of temporary staffing services to the educational vertical. Through organic and inorganic growth, Kelly is transforming itself into a provider of services to higher margin niche specialties. As we mentioned, they're the largest provider of temporary staffing services to the educational vertical. They're the second largest provider of staffing services to the life sciences vertical in the United States. Kelly is a leading managed services provider with $9.4 billion of spend under management. Earlier this year, Kelly exited certain investments in the Asia Pacific region that generated significant capital for the firm, which has been reinvested in acquisitions to drive growth. Growth margins have grown to 20.2% for the trailing 12 months, from 17.6% in 2018, as the company continues to move up the value chain. With no debt and $122 million of cash, management recently announced a $50 million share repurchase program. At the current price, Kelly shares trade at 8.8 times forward earnings, 0.13 times revenue, and 9.4 times EBITDA, compared to a peer group which trades at an average of 11.4 times earnings, 0.62 times revenue, and 7.1 times EBITDA. With the ongoing movement into its higher margin specialties, the overall move to a more temporary workforce and a pristine balance sheet, we believe Kelly Services is well positioned to capitalize on future growth of the workforce. Finally, the last name that we have in this bucket is Lifeway Foods. The symbol is LWAY, trades at $6.75 with a $106 million market cap. We have the name rated as Outperform with a $10 price target. Founded in 1986, Lifeway Foods is the largest producer and manufacturer of kefir in the U.S., an important player in the broader market spaces of probiotic-based products and natural, better-for-you foods. The company's primary product is drinkable kefir, a cultured dairy product. Lifeway is benefiting from the trend by consumers to seek out healthier foods. There is research indicating gut health is significant in assisting activation of the immune system, and kefir can play an important role in gut health. While growing both geographically and capturing additional shelf space, Lifeway has expanded distribution for its kefir product. The company also made an acquisition last year in the drinkable yogurt space, another fast-growing adjacency. The company generates solid cash flow and had $8.2 million of cash on the balance sheet at the end of the most recent quarter, compared to $5.4 million of long-term debt. At the current price, Lifeway shares trade at 0.8 times revenue compared to 1.4 times revenue for the peer group. Given the ongoing move to healthy foods and with significant opportunity for organic growth, boosted by potential acquisitions, we believe Lifeway is well positioned to continue to see top and bottom line growth. Next, we're going to move to the companies in what we call the near-term catalyst bucket. First company we want to talk about here is our DLH Holdings. The symbol is DLHC. Closed the other day at $13.56 with $163 million market cap. We have the shares rated as outperform with a $21 price target. DLH is a pure play government services provider of professional healthcare and social services to various government agencies, with concentrations in the Department of Veterans Affairs, Department of Health and Human Services, and Department of Defense. Last week, DLH announced the most significant acquisition in its history, Grove Resource Solutions. Grove adds an estimated $140 million of annual revenue and $18.5 million of EBITDA to DLH's core $280 million and $29 million respectively. We view the acquisition as transformational and expect it to turbocharge DLH's growth going forward. Excuse me. Grove Resources not only expands DLH's customer base and also its product offerings, and also its offerings are, generally speaking, are at a higher margin than DLH's core. So all in all, a win-win for the company in our view. At the current price, DLH shares trade at 0.4 times sales and 5 times EBITDA, compared to the peer group's 1.1 times sales and 11.2 times EBITDA. We believe the Grove Resource Solutions acquisition to be transformational for the company and vaults DLH up into a new league. Like past acquisitions, Grove Resources adds complementary products and services and new clients that will enable DLH to compete for a broader range of contracts at higher margins. Next, we're going to move to Gabby Inc. The symbol is GABLF. It currently trades at a penny with a 2.7 million market cap. We have it outperform rated with a 5-cent price target. Gabby is a California-based cannabis operator. The company operates one of the state's oldest and most well-known cannabis dispensaries in the San Diego area called Mankind. Mankind is well-known and highly respected with deep roots in the California cannabis industry. The California cannabis industry is the largest by far here in the United States. The current operating environment in California is difficult. There's been oversupply, which has driven down prices. There's been a return to a more normal usage pattern back down from the elevated COVID-related usage patterns. However, we believe there's been an indications of a rebound in the industry, and you're starting to see some better sales numbers come out of some of the companies, including Gabby, in that space. And if federal legislation regarding the Safe Banking Act is passed, it could prove a catalyst for the entire industry, enabling cannabis operators to access the banking system in the United States. Gabby has launched a number of well-received proprietary brands, which generate significantly higher gross margins than third-party products. And Gabby's management has deep and successful backgrounds in retail and franchising, an area the company is exploring to help boost further growth. At the current price, Gabby shares trade at 0.2 times revenue, compared to an industry average of over 2 times revenue. Operating in the largest U.S. cannabis market with a leading dispensary, proprietary brand names, and organic and inorganic growth opportunities, we believe Gabby will be able to successfully ride the cannabis wave. The next name we want to talk about is Schwazze, symbols SHWZ, currently trading at $1.50 with a 90 million market cap. We have it rated as outperform with a $4 price target. Schwazze is a multi-state vertically integrated cannabis operator with leading positions in Colorado and New Mexico. Highly respected management team with a background in the highly competitive grocery industry. Schwazze's operating plan is to go deep in its existing markets while looking at other attractive state markets to enter. This is one of our favorite names. The company currently operates 25 dispensaries in Colorado and 14 in New Mexico, as well as grow and manufacturing operations in both states. Cannabis is a fast-growing, recession-resilient business and is projected to grow at a 24% CAGR through 2027. Schwazze is developing a house of brands, both on the retail and wholesale side, which we believe will not only drive margins, but also valuation multiples. We also would note the recent insider purchases at current prices by the CEO, who already owns a significant stake in the company. And like Gabby, any passage of the Safe Banking Act will be a net positive for the company. At the current price, Schwaz shares trade at 2.9 times EBITDA compared to an industry median of 6.5 times. We believe there is significant upside potential in Schwaz with organic and inorganic growth opportunities. Any passage of the Safe Banking Act can provide a further catalyst to the shares, in our view. We're going to now turn our attention to Comtech Telecommunications. The symbol is CMTL. Stock trades at $13.37 with a $351 million market cap. We have it rated outperform with a $15 price target. Comtech is a leading global provider of satellite and space communications and terrestrial and wireless network infrastructure to commercial and government customers around the world. The company is a leading global provider of satellite ground station equipment, including satellite modems, satellite amplifiers, and satellite antennas. The company also is a leader in the next generation 911 public safety market. The catalyst for Comtech is a new industry experienced management team with a track record of success in the creation of innovative technology-enabled solutions addressing some of the world's most challenging customer problems. Both the company's end markets are in the early stages of an upgrade cycle, with the next generation 911 business projected to double in size to $1.8 billion by 2026, while the satellite ground station equipment market is also expected to double in size, this time to $9 billion by 2029. And we expect to see a convergence of both the terrestrial and satellite spaces, likely creating an even larger addressable market. At the current price, CMTL shares trade at 0.69 times depressed trailing 12-month sales. We believe the market currently sees Comtech as a collection of independent businesses operating in silos, but the new management team is implementing a one Comtech platform that will lower costs, improve operational and performance, and enable the company to prosecute market opportunities that the individual businesses could not. While early days, we are encouraged by the steps the new management team is taking and believe there are ample, exciting growth opportunities, both near and long term, for Comtech. We're now going to switch our attention to the near 52-week low bucket. First name here that we're going to talk about is Vivagen. The symbol is VIVXF. Stock trades at 6 cents with a 4.6 million market cap. We have an outperform rated with a $1 price target. Evogen is an early revenue stage life sciences company focused on developing and commercializing products for livestock, companion animal, and human applications. By unlocking an overlooked facet of beta carotene activity, a path has been opened to safely and economically support immune function, thereby promoting general health and performance in animals. Vivagen's OxyC beta product can replace the use of antibiotics in feed animals, a long-term goal of many nations. OxyC beta livestock premix is currently being sold as a non-antibiotic feed additive in China, Vietnam, Philippines, Brazil, Thailand, Taiwan, Mexico, and Malaysia. Additional market approvals are expected, and with the help of its marketing partners, the company is well positioned to capitalize on the movement away from the use of antibiotics in feed animals and longer term, the potential inroad into human applications. Given its pre-revenue stage, Vivagen does not have any current valuation multiples, but we believe long term, the company's focus on healthier ways of living will drive top and bottom line. The next company we want to talk about is Black Box Stocks. Symbol is BLBX. Trades at 39 cents with a 4.9 million market cap. Outperform rated with a $3 price target. Black Box Stocks develops and markets financial technology and social media hybrid platforms. It offers a black box system, a subscription-based software as a service that provides real-time proprietary analytics and news for stock and option traders. While the market decline in 2022 has negatively impacted growth, black box stocks will introduce new products in 2023 that will expand its addressable market from day traders to the over 100 million self-directed investors and the professional money manager market. We believe that the company's marketing strategy, along with the upcoming products, can help stabilize the subscriber base and increase the company's total addressable market. Black box stocks has been repurchasing shares at these depressed levels. At the current price, BLBX shares trade at 0.86 times revenues, a significant discount to other comparable fintech companies, which trade at an average of 5.3 times revenue. The next name we want to talk about is FAT Brands, symbol is FAT, trades at $6.30 with 104 million market cap. We have it outperform rated with a $25 price target. This is another of our favorite names. FAT Brands is a leading global franchising company that strategically acquires, markets, and develops fast casual, quick service, casual dining, and polished casual dining concepts around the world. The company currently owns 17 restaurant brands and has over 2,300 franchised units worldwide. The company's strategic focus is on generating revenue through franchise fees and royalty streams via an asset-light model. The company has been an aggressive acquirer of restaurant concepts with opportunities to enter new markets and eliminate overhead. Growth is being driven by both organic measures and synergistic acquisitions. The company has a pipeline of over 1,000 units to be opened by franchisees that will increase annual EBITDA by over 50%. Recovering from the pandemic lows, FAT has experienced multiple quarters of increasing sales growth and increasing adjusted EBITDA. At the current price, FAT shares trade at 12 times 2022 pro forma EBITDA compared to 16.9 times for the peer group. We expect to see FAT Brands to capitalize on the nearly unlimited organic and inorganic growth opportunities, while at the same time seeking out ways to lower its borrowing cost, all of which will improve reported operating results and drive the shares higher in our view. Our next name is Great Lakes Dredge and Dock. The symbol is GLDD. It trades at $6.68 with a 470 million market cap. We have the shares rated as outperform with a $14 price target. Great Lakes is a marine and environmental infrastructure contractor and the largest dredging company in the United States. Headquartered in Houston, the company provides port expansion and maintenance, coastal restoration, river dredging, and environmental restoration for public and private entities worldwide. With a historic 35% market share here in the US and one of the youngest fleets in the business, Great Lakes is well positioned to capture additional business as governments have expanded spending focus on Great Lakes markets. For example, there is record funding for the Army Corps of Engineers, there is $9 billion in the Harbor Trust Fund, and the recently passed U.S. infrastructure bill includes funds dedicated to flood control and waterway dredging. A huge upside wildcard is the company's recent participation in the offshore wind market. The company is building the first Jones Act compliant vessel to compete in the subsea rock segment for offshore wind farms. Offshore wind farms have been a huge focus of government, and this is expected to see significant growth out through 2030, and then even further from that going forward. While it's early days, the government goals for offshore wind could open a large new market for Great Lakes. At the current price, GLDD shares trade at 0.7 times revenue and 9.6 times EBITDA. Our next name is Kratos Defense and Security Solutions. Stock symbol is KTOS. It trades at $9.06 with a 1.3 billion market cap, outperform rated with an $18 price target. Kratos develops and fields transformative, affordable technology, platforms, and systems for U.S. national security related customers, allies, and commercial enterprises. Kratos is changing the way breakthrough technology for these industries are rapidly brought to market through proven commercial and venture capital-backed approaches, including proactive research and streamlined development processes. At Kratos, affordability is a technology. The company specializes in unmanned systems, satellite communications, cybersecurity warfare, microwave electronics, missile defense, hypersonic systems, combat systems, and next generation turbojet and turbofan engine development. Kratos' high growth potential unmanned tactical systems products are the only systems flying today that meet various defense needs. Unfortunately, many of Kratos' programs have been pushed to the right, partly due to COVID and partly due to changing government requirements. Nonetheless, we believe the company is well positioned to capitalize on future growth in the defense and satellite sectors. At the current price, Kratos shares trade at 1.5 times revenue. Our next name is One Stop Systems. Symbol is OSS. Shares trade at $3.09 with a $61 million market cap. We have it rated as outperform with an $8 price target. One Stop Systems designs and manufactures innovative AI transportable edge computing modules and systems. These products are used for AI data set capture, training, and large-scale inference in the defense, oil and gas, mining, autonomous vehicles, and rugged entertainment applications. Here, One Stop Systems is capitalizing on a significant change in where data is created and processed. In 2018, about 10% of generated data was created and processed in place, or what they call at the edge. This is expected to explode to 75% of all data created and processed at the edge by 2025. The company's targeting multi-billion end market applications. Its edge computing capabilities are unmatched in our view. While the markets are in the early stages, One Stop Systems has been increasing its value proposition, differentiation, barriers to entry, and compounding growth in financial performance each year. The global edge computing market is estimated to grow at a 38% CAGR through 2028. One Stop Systems has a solid balance sheet with $12.7 million of cash and investments and just $3.1 million of debt as of September 30th. At the current price, OSS shares trade at 15.2 times forward earnings, 0.9 times revenue, and 20.5 times EBITDA. OSS continues to post growing operating results while expanding its market presence in numerous verticals. Now I'm going to move over to Orion Group Holdings. The symbol is ORN. Shares trade at $2.40 with a $78 million market cap. We have the shares rated as outperform with a $6 price target. Orion Group is a leading specialty construction company providing a broad range of construction services both on and off the water in the continental United States, Alaska, Canada, and the Caribbean basis through its heavy civil, marine, and industrial construction and commercial concrete construction segments. The company is a leader in both of its segments. Like with Great Lakes, Orion is benefiting from increased spending on waterways, while its Texas-focused concrete business is riding the coattails of the movement of people into the state. In late summer, Orion announced a new management team, including a CEO with extensive experience in the construction industry. As the new management team implements its vision, we expect to see improved operating results. At the current price, ORN shares trade at 0.11 times sales and 9 times EBITDA. With the new management team, exciting growth opportunities, and expanding addressable market, we believe Orion will be able to grow top and bottom lines at an accelerated pace going forward. The next name we want to talk about is tokens.com. The symbol is SMURF. The shares trade at 10 cents, has a $12 million market cap. It's outperform rated with a $1.50 price target. Tokens.com invest in Web3 assets and build businesses linked to crypto staking, the metaverse, and play to earn gaming. The company enables public investors to achieve exposure to Web3 assets on a diversified basis. The company focuses on three operating segments: crypto staking, the metaverse, and play to earn crypto gaming. Tokens.com owns digital assets and operating businesses within each of these three segments. Staking operations occur within Tokens.com, metaverse real estate, and e-com 3 solutions operations occur within a subsidiary called Metaverse Group, and the crypto gaming operations occur within a subsidiary called Hulk Labs. All three businesses are tied together by the utilization of blockchain technology and are linked to high growth macro trends within Web3. While the crypto winter has impacted the overall Web3 space, we believe Tokens.com is an interesting option to invest in Web3 assets on a diversified basis. Our next company is Vera Bradley. The symbol is VRA, trades at $4.69 with $124 million market cap. We have the name rated as outperform with an $8 price target. Owner of the iconic Vera Bradley brand, the company operates through its two lifestyle brands, Vera Bradley and Pura Vida. Vera Bradley designs, manufactures, and sells women's handbags, luggage, and travel items, fashion and home accessories, and gifts through brick and mortar as well as e-commerce channels. Pura Vida markets a differentiated and expanding offering of bracelets, jewelry, and other lifestyle accessories, mostly through e-commerce, but more recently through a couple of brick and mortar stores. Both brands enjoy devoted, emotionally connected, and multi-generational female customer bases. Inflation, supply chain issues, recession fears, and changes to e-commerce marketing have all negatively impacted the company recently. However, Vera Bradley also recently appointed a new CEO who is tackling these challenges and putting together a plan to return the company to growth. We believe there are opportunities for long-term sustainable revenue and EBIT growth. Vera Bradley has a strong balance sheet with $25 million of cash and no debt. The company has been a consistent repurchaser of shares recently. At the current price, VRA shares trade at 0.26 times revenue compared to nearly 1 times for its peer group. Well, that's all the names that we have to go over today. Hope you've found this informative. Any questions, feel free to reach out and give us a call. Thank you for your time, and we'll return it back to the operator.
Joe, thank you for that. We have time for a few questions here, so we'll jump right into it. Our first question is, where do you see Fat Brand's future growth coming from?
So, pardon me, the interesting part on Fat Brands is it really has two significant growth legs. The first is this 1,000 store backlog of locations that franchisees have paid for and contracted to open. As we mentioned, those 1,000 locations could increase current EBITDA by 50%. We believe the majority of those stores could be open over the next 5 to 7 years. It's a low-cost way for Fat Brands to drive up its own top line and EBITDA. The second is acquisitions. Now, the company's been pretty aggressive in making acquisitions in the past. They've spent most of this year digesting acquisitions they made in 2021, but we would expect them to be on the prowl to add more names, more concepts to the portfolio here in 2023.
All right, and our next question is on Schwazze. The question is, what could safe banking mean for Schwazze?
Safe banking could be a game changer. Currently, cannabis is a cash business. You cannot use credit cards in the dispensaries, which is dangerous for the people, customers that are coming in, having, the cash, dangerous for the workers because the dispensaries are full of cash and everybody knows it. Safe banking not only enables the use of credit cards for purchases of cannabis, but also has a couple of other things that it could significantly positively impact the operating environment. For example, currently, the companies restricted, cannabis companies are restricted to using state chartered banks. They cannot use federally chartered banks. So you can't go to a Citibank or Bank of America. You're having to use smaller local banks. Typically, that it means that you're paying higher fees, you're paying higher interest rates, you're not getting the breadth and depth of financial products that some of the larger banks could provide you. So if safe banking is passed and that's included, and that gives them just another area that they could take advantage of being able to enjoy that full suite of financial services that are offered, and hopefully at lower rates, whether it be fees or interest rates, which would obviously positively impact the bottom line.
Great. So, okay. So our next question, you'd mentioned the new management team at Comtech. So the next question is, what changes have the new management team made at Comtech?
So it's still early days there, but historically, when you looked at Comtech, even though it was one company, the company had been built kind of on the back of acquisitions, and pre-existing management had kind of left each one of those businesses alone. So there was no centralized inventory or centralized purchasing, or centralized, how do we go after this client? It was more siloed, and each silo selling their own products, doing what was their own best interest. So immediately, when new management came in, saw that and said, no, we want to do this one Comtech. Just as an example, you might have one part of the business that needs a certain inventory item, but they can't get it. The supply chain was really long. Who knew when they were going to be able to get it to sell their product that they manufacture, not knowing, because they weren't on one common system, that another subsidiary had that product. So obviously, putting everything on one common process and standard and protocols, those are the early low-hanging fruit types of things that they're doing. And then, even to the point of, you can take, two of the previously individual silos, put them together, and you might, instead of being able to just sell products, be able to sell subsystems or sell systems. So you're moving up the food chain to your end client base, which generally means higher revenues, higher margins. So again, it's very early days. They've been there, for basically one quarter, but you're starting to see those movements being made at the company, which we think will all be positive impacts going forward.
I think we have time to fit one more in here. So this question pertains to DLH Holdings. The question is, what does the new acquisition announcement mean for DLH?
It's a game changer. Short answer. DLH had a 165 million market cap. They're paying 185 million for Grove. It just really turbocharges the growth here for the company, and not just bringing in, obviously, the revenues and EBITDA. That's very important that they will bring in, but it expands the market opportunity for the company. They're bringing in over 500 million of backlog, which will pretty much double DLH's backlog. It again will enable DLH to bid on a broader range of contracts, which will help drive margins, reduces the importance of any one contract in the overall scheme. So and again, the business at Grove historically has been at higher margin than DLH's business. So you should see increased revenues, higher margins, and the opportunity to win even more business at higher margins. So all in all, it looks early days. Like I said, the announcement was made last week, but at first glance, looks like a huge win for DLH.
Awesome. Well, that's all the time that we have today. Joe, I want to take this moment to thank you for your very informative presentation.
Thank you.